The Federal Reserve kicking off its easing cycle with a half-point rate cut. Officials projecting they will lower interest rates by another half of a point before year end. But Fed Chair Chair Powell making it clear in his remarks that officials aren't on a preset course and will continue to make decisions meeting by meeting. Here with us, we want to bring in Dennis Lockhart. He's the Federal Reserve Bank of Atlanta's former president. Dennis, it's great to have you here joining us this morning. So the market taking it, at least, they're not too worried about maybe what this 50 basis point cut could signal just in terms of higher risk of a recession. What's your take and your reaction to yesterday's decision?
I think it was, on balance, an optimistic message. It was not necessarily a reaction to anything particularly wrong. I think the committee is increasingly confident that inflation is under control, and they like where the labor market is, and they want to protect that. So it's really not a message of reaction to things going haywire. It's more to preserve a good thing.
You take us into what the conversations, what the thought process is typically like when you have this many committee members that are all in alignment and really just one dissenting vote.
Well, I think when the Fed pivots, it's certainly desirable to see pretty much a unified face, and they achieve that one dissenting vote from a governor, I'd point out, and that's somewhat unusual. Governors usually don't dissent. They usually go along with the chair. But nonetheless, the committee showed that everyone supported 50. I'm sure there were some who argued for 25 in the meeting, but everyone was comfortable with the 50 basis point move.
And Powell, during his press conference, really emphasizing the fact that this is a start of this recalibration process. So as we look ahead, what do you think, Dennis, that recalibration process more accurately looks like?
I think it will be a meeting-by-meeting judgment of what the economy needs, with some caution about the ability to react, perhaps with a deeper cut, if necessary, to some development that comes along. This morning's newspaper is, of course, talking about the potential for a longshoreman strike on the East Coast. That would be a mini shock to the economy if it lasted very long. So I think they will feel their way along, and there, as Chair Powell said, there is no preset path. Each meeting, they will decide what is the appropriate move.
So then, Dennis, when we talk about what's necessary, or I guess what the Fed would need to see in order to be comfortable with another 50-point basis move, you talk about the fact that we see some sort of shock. How would that then be reflected in the economy and the labor market, just in terms of the further deterioration maybe that would be necessary in order to justify another big move?
Well, I think the way that they're thinking about this is they want to preserve as much flexibility, or optionality is the word that's often used, as possible. They, I think, emphasize that the 50 basis point move yesterday was like a down payment. You could even argue it was a little bit of a catch up from what could have been done in July. So I think the base case should be 25 basis point moves, not 50, and no pause in the outlook at the moment.
We had an instant reaction from Rick Reeder of BlackRock, the chief investment officer of the Global Fixed Income Group. And he had mentioned that the key takeaway from the move was that it will resonate through the financial system for the coming months, is that the Federal Reserve will be lowering interest rates persistently for the next 2 years. What do you think continues to need to play out over those next 2 years for it to make sense for cutting to be taking place for that protracted an amount of time, and ultimately what that does for the targets that they should be setting, both for employment, and inflation?
Well, for that to play out without any pause, without any, let's just say, deviation from the mode of 25 basis points, or we're going to have to see the economy settle into a long-term equilibrium that justifies a march to the neutral rate, which round numbers I think is viewed as around 3%. So I think that's what Rick Reeder is talking about, and it could happen. But in my experience, there are always surprises. There are always things that come along that take you off of that course.